I'm going to introduce these guys to you shortly, but we do want to encourage you tonight to ask lots and lots of questions because that's what it's about. And we're going to have a mic to pass around, but as I said, we've got some great talent here and a really good lineup for you this evening. So, guys, I want to ask you first of all, hands up who thought about buying a property in the last 12 months? Thought about it. And hands up who bought a property in the last 12 months? Hands up. 1, 2, 3, 4. Congratulations, because you made 10 to 20% on your purchase in the last 12 months, which is incredible. We had 13 interest rate rises and you still made 10 to 20% on your investment. So if we just break it down for a moment, the average sale price on the Northern Beaches is, let's call it $1.2 million. That's approximately $120,000 to $240,000. I don't know about any of you guys, but that's a huge amount of money in anyone's book. So the market's in really, really good shape. Even with all those interest rate rises, I think what I just mentioned to you is testament that real estate is an extremely resilient investment. What we find over a weekend usually is that everyone becomes a mortgage broker, an accountant, a real estate advisor. But tonight we've actually got the real deal for you. So, to introduce you to our speakers for this evening, we've got Theo Chambers. Theo is from Shaw Financial. He is runs one of the top independent brokerages in the country, and he's very well known for his motivating influence. We're very fortunate to have Theo here with us this evening. We've also got Emmanuel Calligaris. Emmanuel is from CCS Partners. I have personally known Emmanuel for a lifetime, and Emmanuel's just going to bring a wealth of accounting knowledge that anyone can understand. So, again, we're very fortunate to have Emmanuel here this evening. And then we've got Mark Novak. Many of you will know Mark. Mark also doubles up as my husband, for anyone who doesn't know, but he is certainly a pioneer in the real estate industry and has been working in real estate for over 30 years. So I'm going to pass over to Mark, and then we are going to be encouraging you guys to ask lots of questions this evening.
Hi everyone, thank you so much for coming. A bunch of hungry minds to turn up. There's a lot of content that you can consume online, and I really respect and appreciate everyone come out tonight with their own time, because I do think the depth of knowledge that you can get face to face is very different to what you can find online. And the big thing I think is it's very local what we're doing tonight. So it's very easy to get caught up in media and people that are talking about national things that are happening to us, and to find out what's happening in DY, to find out what's happening in the Northern Beaches on a legal level, on a mortgage level, on a real estate level, I think is great. I'm going to do probably turn it around on its back and do what speakers shouldn't do. And I'm going to give you the nugget at the beginning of the night that I've got to give. That nugget I'm really passionate about when it comes to property. We do a lot on social media, and people very quickly like to talk about the negatives out there in property, and it's quite hard not to hear that noise when you're out there, and people aren't sort of really affectionate with, wages aren't doing what they should be doing to support, the property market increasing. What I will say, this is not the nugget, but what I will say is the property market has been excellent the last 100 years, and it will be excellent the next 100 years. So although we're very sort of on the edge, what are interest rates doing, and, thinking what's happening, you are always going to be playing that long game. And the people that I've met in real estate that are fabulously successful, they all share that one common thing. It's that long range, that long game attitude that they have. So I really encourage you to look at that. The nugget that I want to give you tonight is just to bring everything into focus as to relativity on a small and large scale. I was sitting with a friend going through Theo's presentation that we're going to go through together. And when I went through that, probably the smartest guy that I know and that I've met, and we're sitting at that steel table. There's normally a steel table that sits over there. We're going through the notes. And I said, Ed, do you realise that, there's $10 trillion worth of properties? He said, yes, I do, Mark. This guy knows he'll make your head spin with any number in the financial market. He's a stockbroker. He said, yep, I know that, $10 trillion of property. Ah, that's incredible. And I said, how much in the stock market is there? And he said, oh, there's just short of $3 trillion. And then I called Theo today and said, Theo, how much money is there in loans in the mortgage market? He goes, oh, shit. And busted head. Then he was like, just under $3 trillion. So to have that much property in the market, that value of property in the market, and to be having only a 30% exposure, 30% loan, it's crazy. Now, the one that I really was passionate about, that was great timing, Jono. Jesus, you're a mind reader. No cue. The one that I was really passionate about was super. Now, that number blew my mind. That's the nugget I'm going to give you tonight, and let me explain why. Superannuation, it's cash. It's not leveraged. Superannuation was designed in 1992 when Mr. Bob Hawke was in government, and he turned around and said, we're going to make Australians pay for their retirement. Putting that into perspective, that was over 30 years ago that he made everyone in the room pay for their retirement. And they've built up a war chest of $3.5 trillion. Who cares? Big number. What does it mean to me? So I said, Ed, who cares? Big number. What does it mean to me? And Ed said, there's 8 billion people in the world. Yes. Australians are less than 1% of that. They're 0.4% of that. Yes. $3.5 trillion is a war chest for your retirement. $3.5 trillion is the fourth biggest amount of money we have in the world as a country. Australia ranks fourth in their war chest for retirement. So I guess if I was in the room and asking everyone about their future and everyone's saying, shit, got to buy a property, got to invest, got to do this, I do have to say, as a country, to be number 4, we're not the fourth biggest economy, right? Our GDP is not the fourth biggest, but our war chest is $3.5 trillion in cash. Now, what that is now coming to a point where it's moving to 12%, your contributions, instead of being 9.5 or 10.25, whatever it is, that's now going to be moving to 12% in the next couple of years. This thing is a beast. And mum and dad investors, going back to the 80s, you'd be sitting at a dining room table and there'd be 10 people at the dining room table. You'd probably have 2 families, 2 couples that would have an investment property sitting at that dining table. And the government came along and said, you know what, that's really not right. We want to make sure everyone sitting at the table has something for when they retire. It's better for the government, right? But if they can look after the people, that'll happen, and it's happened. Come on through, sir. Don't be shy. Don't mind you. Come on through. And if anyone else wants to come through, just come on down, because I think there's some other people at the back. No, everyone's in. Okay. All right, so feel good about that. What are you going to do about that? There is your traditional investment arm, which, mum and dads have always done in the years, but that's really been stressed, because when you're giving away 10% of your income, I don't care if the employer's paying it, you're paying it, how we got there, we're giving away 10% for super. That robbed and took away from mum and dad investors to go and buy a property organically, go take it to a real estate agent, off they go. And super was half pregnant. It wasn't enough to buy a property for individuals. but it's been a growing asset. So now it's getting to a stage where there's quite a lot of money there that people can actually go and buy a property with it, or when they're getting to 65 or 67, they're looking pretty good. I'll bring up the next one, Jono. Okay. People have been asking me, what's Mark buying? Now, I've set up tonight an SMS responder for you. If you pick up your phone right now and you type the number 0460 111 111 and you write the word smart, you're going to get Theo's presentation early. But if that screen's not big enough, you can read it on your screen and on your phone. The presentation's going to come through. If you write the word Bunnings, that's what Lisa and I and our family have invested in lately. It's some warehouses up the road. Of course, I'm going to try to sell you something tonight. Kill me. That's what we're personally doing with our own money. That's what we're recommending. We'd love you to talk about us with us later about that. And then the final slide. I am really passionate, and this is something we're managing almost 2,000 landlords now. That's landlords' properties. That's probably about 5,000 landlords. There's probably about 5,000 or 6,000 tenants. We're highly exposed to the local market. When anyone comes to me and says, Mark, what's the advice? What do I do? What do you think? I want you to think about compounding interest. That's the big key of property, where you can have $1 and then go and borrow $5. We're going to expand on it a bit more. You can have $100,000 and you can go and borrow 500,000 with that, and they will let you keep the interest of the 500, 600,000 purchase, and they will let you keep, the rent, and they will let you keep the capital growth on the whole amount. Best thing I want, and this is something you can tell your kids, your friends and stuff to do, is SMS Warren, again tonight, 0460 111 111. And what will come to you is a trailer about Warren Buffett. It's called Becoming Warren Buffett. A couple of you have probably seen it. One of my favourite views. It talks about compounding. It talks about how he leverages, and that the philosophy of compounding. It's 1.5 hours of genius. He is a genius. And that's what I see in common with our landlords, our investors and people buying in property. They have the ability to compound. I've also put a compounding calculator because I'm a super nerd. I pull out the compounding calculator with my kids' friends and my customers' kids. When they go, can you tell little Johnny he should buy a property? I go, okay. Grab the compounding calculator, put in $100 a week, do it for 10 years, and the compounding calculator, real simple calculator, shows you when you compound interest, how much money that'll make. It is frightening when you see the compounding, how it works. Think about that tonight, guys. Thank you, and I'm going to hand over to Theo.
Thanks, Mark. Oh, please. Hello? There we go. Hello, ladies and gentlemen. The point of tonight, like it's already been covered by Lisa and Mark, our aim is to give you as much information as we possibly can to help you make an educated decision in the current sort of landscape and current economy. But also moving forward, we are not here to sell you anything. If we can look after you and help you with your finance needs, great. But the goal of all the things that we'll be going through is just purely on an educational basis. On the note of something that Mark just touched on, two things there that I wanted to comment on. One thing about the superannuation, it's a hot topic at the moment, and I'm not sure if people have been reading the news, but you can hop on Google and see that 3 trillion in superannuation at the moment. For the last 5 years, nearly 80% of all retail super funds, so I think the exact percentage was about 77%, so we'll call it 80, didn't even meet the ASX index in performance for the last 5 years. So all that $3 trillion has been being managed by people that are just clipping fees, and it's not really performing, in my opinion. You're better off taking it out of a super fund and just buying the index. 80% of the time, you're going to be ahead. And for the last 5 years, it's not an anomaly, it's for the last 5 years. And the other thing to Mark's point, you know, he was maybe talking about compounding there, and when he was referring to the power of leverage, in my opinion, and that goes for the superannuation as well, which we'll touch on. So we'll jump in there. I think we've already done the intros, right? Yep. So first thing, we'll do a bit of a snapshot of the finance world at the moment. This isn't any news that you haven't heard before, but just in a quick summary, we've got the RBA tackling inflation at the moment. They've achieved a bit of a tackle, you could say. It's come down, but it's not down to the target, which is that infamous 2 to 3% target that they're putting all over the media. The current quarter of inflation is the most crucial to the decision making of interest rates moving forward. The speculation that you keep hearing about August being a rate cut, a rate rise, half the economists say rising, the other half say cutting, and it's always August as the common denominator. The reason being is the current quarter of inflation data will come out in July, and basically off that, at the end of July, and off that data, they'll make a decision on what to do with interest rates. Yes, there was some inflation released about a week ago, being the monthly indicator. The monthly indicator did show that there was an increase, and that may mean that there could be another rate rise to come. However, the monthly indicator for inflation is not as detailed as the quarterly. The quarterly inflation data is the more comprehensive data that we make decisions on as a country. So yeah, I think we covered the first one. So just what the goal of this slide is just to quickly highlight, every time we've seen an increase, there's been a decrease quickly after, and we're nowhere near where we've seen the cash rate be in the past, although the economy globally has probably got a bit more debt in it. But this is the biggest increases we've ever seen on record, 13 increases. If you actually include the increases as 25-point increments, it's 16 increases, because we had 3 rises of 50 points. So biggest increase in the cash rate history. We saw the other 2 big increases, the GFC, they didn't know what to do there. They went up and they went down. And then the introduction of GST caused a bit of an inflationary problem in 01. But we'll move on. It's important to watch what's going on in the US, because even if inflation gets under control locally in Australia, but they don't get inflation under control in America, we are somewhat tied into their problems, because the US Federal Reserve, their cash rate is already almost 1% higher than ours. And that is making our dollar crash, because in a short version, basically the global bonds market, people go buy bank bonds in America if their interest rates are higher, because the bonds are paying better yields. And if our interest rates are much lower, they're selling our bonds to buy US bonds, because they'll get a better return on the money in the US. If they're selling billions of dollars worth of AU bonds because US bonds are more attractive, our dollar plummets. And our biggest industry is mining, so our dollar is crucial to us. On top of that, a crashed dollar can actually have inflationary problems on imports as well. Things become more expensive. So for that fundamental reason alone, if the US increase rates, we have to follow, no matter what is going on in our housing market. We've got companies like BHP being the biggest taxpayer in Australia, paying $13 billion in tax. It's better to keep those businesses afloat than the housing market in the federal government's eyes, unfortunately. And they'll make that decision. But we'll go on. The US, on a positive note, does look like they're tackling inflation. That's the history. We don't need to sort of go into that in too much detail, but you can see the US were a bit more on the front foot. They have a monthly indicator, which is more accurate than our quarterly. So they were a bit more aggressive on their cash rate movements. We'll keep going. We saw, so as you probably know, the Australian government wants unemployment to rise. Bad news is good news, unfortunately, because they're trying to slow down the economy. And most recently, we saw unemployment hit 4%, and they want to get it to more like 4.5%, 5%. And it's going in the right direction. Sadly, not a good thing for some people, though. We'll keep moving. So in terms of assessing what's going on in the world, I'm sure some of you are feeling this yourself, but this is a summary of all those 13 increases on a $500,000 loan example, what it equates to in repayments as a difference. So that bottom figure right there, $1,238, that's the increase in repayments on a $500,000 loan over the last 18 months, I think it is. May 22? Yes, May 22. I think the next slide gives a $1 million example, does it? Yes. So on $1 million, obviously just about double, 2,400. So that's impacting their households quite a lot.
13 months of rate rises, and every one of those months property went up. Now, of course, I'm going to speak that and be happy about that, be proud of that. But again, I think it shows what good resilience we have in our economy and as people, as much as people turn around and say, oh yeah, it's not going to do this, it can't do that. Like the bottom line, 13 rate rises and every single time, every month, property values went up. Thank you for listening.
Yeah, there's a slide saying how basically the opposite has happened every time they think something's going to happen with the forecast, which comes on dwelling values in a second. So we'll keep going. This is the other side of the spectrum of rate rises. So obviously increasing interest rates affects households and their mortgage repayments. The other side is buyer affordability. And this was what might make buying now opportunistic, because buyer affordability has never been more crushed in terms of your borrowing capacity, right? So that 13th rise we had in November, that equated to a total reduction in your borrowing capacity by 47%. So if you came and saw us at the start of 2022 and said, I want to get a loan, and I said, your max serviceability is a $1 million loan, today it's now 530. So it's effectively halved.
It's massive.
And that's why it's surprising, to Mark's point, that there's still strong prices in markets when affordability in terms of borrowing capacity is effectively halved. I've got some data on that coming up soon as well. So just to break down what's that actually costing people, a 4% increase on interest rates in different scenarios, a 500 grand loan to a $2 million loan. If we use the $2 million loan at the bottom there, you're basically paying triple the amount of interest now, from $42,000 a year to $122,000 a year. It's a big difference. That's just interest, principals on top, right? So it's a huge difference. And that's why we're seeing some people actually struggle with holding investment properties, for example, if they were too leveraged when they purchased them. Now they're looking at selling investment properties to pay down owner-occupied debt. It's a bit of a big shift in like a debt recycling, you could say. A lot of people reducing owner-occupied debt because you pay owner-occupied debt net after tax on the interest, which I'll let the accountant cover, and the deductible debt is the opposite. We'll keep going. This is just breaking down the difference in the cash flow. I think we'll skip through this one just in the interest of time. This is the infamous mortgage cliff. So I'm sure you saw this in the news. We had, I think, CBA alone, it was $370 billion worth of fixed rates at 1.99, all coming to maturity in a 2-year window. At the bottom there, you can see the window. They're in quarters. So the bulk of it was from actually June last year till Christmas. That's when all the fixed loans from COVID with that federal offer of 2% were maturing and going to 6%. Everyone sort of was predicting or anticipating there would be a correction in the property market when that happened. It didn't. There were definitely an increased volume of listings at the start of this calendar year, which I would link to that fixed rate cliff. But that increased volume in listings was also met by an increase in clearance rates. So to put numbers on it, January, February last year, every Saturday there's about 350, 400 auctions booked in across Sydney every weekend. This year it doubled to tripled, sometimes 600, went up to 800, 900 some weekends, and clearance rates was above 70%. So quite surprising. We'll keep going. We're at the end of that cliff, as you can see, not many, it's probably another year left of those fixed loans coming to maturity. So this is the point that Mark was touching on. So Ironically, this is dwelling values across Australia. Ironically, when rates were still low in mid-2022, but rates started to go up, the power of speculation is bigger than the actual fundamentals of these households. The market in 2022 actually came off when rates were still low, but people thought the market was going to come off, and that creates it. People were scared, no one was looking. For that last 6 months of 2022, confidence was shot. Now, ironically, in the last 6 months of last year, when rates were peaking and people's affordability was crippled, prices ran. The opposite of what you'd expect in both situations. We'll keep going. This is just the dwelling values across Sydney. Like Mark said, I think you've got a copy of this on your phones if you send that SMS, so you can have a look at this. We'll keep going. Okay, so this is probably getting a little bit too technical, but just we're breaking down markets here. So I guess the next part of our presentation is to compare asset classes of where, for example, your super might be invested, let's say in the ASX or other areas you can invest in across Australia. We can't quite see the Sydney, but I think that's 7% was the average growth in Sydney houses for the last 10 years. I believe so. And a 4% increase in a 4% increase annually in rent, which is a 3% yield. Naturally, houses have a lower yield. We'll keep going to a slide that actually breaks it down. We'll skip past this one as well. This one gets a lot of airtime in the news. So the supply of housing. Supply is at a 10-year low. Supply of new housing, especially in Sydney. In Sydney, it's exaggerated out of the whole country. Our state government and councils don't make it easy to build homes. We are at the turning point. Building approvals, which forecast supply, have bottomed out and they're increasing again. And if you've been watching the news, the state government has made some good initiatives on overruling local councils to make sure subdivisions and various sort of medium density developments get through. Because the roadblock in the past was state government would release initiatives and councils will have their overarching policies. Now it's flipping the other way. Now the state government will get the final say.
What I see is interesting is everyone talks about population going through the roof, but there was negative population growth for a long time, for an equal population negative as there is a positive now. So it's sort of been fairly level. If you look at the last 10, 20 years, it's been fairly consistent. So yes, we lost some people and then we really gained some people. Where it's going to go next is going to be the interesting one.
So that's the building approvals. You can see turning around the right way. Like I said, you've got this on your phone, so we'll keep going. So this is on that migration sort of comment to Mark's point. Everyone thinks that we've opened the floodgates and we're going to have all these backpackers on the streets looking for jobs. There's skilled workers being sort of imported, you could say, into the country, and now migration levels are just returning to where they previously are, as you can tell on that slide. The net migration, the net annual gain is the key figure, which is accounting for also people leaving the country. And that you can see that on the left there being 500,000. I think the migration is a great thing. We probably need more skilled workers. On the comment of skilled workers in the construction space that are hoping to make a difference with the shortage of trades and whatnot, there's only about 5% of those workers are in the construction space. So we need a lot more. We'll keep going. What does a population increase equate to? So in the past, a 1% increase in population normally equates to an 8% increase in house prices. That's nationwide as well. You can see the major beneficiaries of that in terms of cities. We'll keep going. So this is the one that probably a lot of people care about. Where are interest rates going? I wish I had the crystal ball because these four banks get it wrong every 4 to 6 weeks. I feel like they're changing their mind and changing their opinion on which way the rate rise will go. At the moment, it's looking like the end of the year. Like I said, the current quarter of inflation is the biggest dictator on that. What goes on in the US is the other consideration, but both are somewhat optimistic at this stage. Even if inflation eases in this current quarter, I don't see a knee-jerk reaction to decreasing rates until the end of the year or early next year. But when it does start decreasing, as you can see there, we're looking at at least 1% worth of decreases over the next 18 months. That will, going back to that slide on borrowing affordability and borrowing powers, naturally that's going to make a big increase in what people can afford and their serviceability and borrowing capacities. We'll keep going. This one got a lot of airtime in the media as well, the stage 3 tax cuts. Just a quick highlight there. You can see the main beneficiary is that 45 to 120,000 income sort of tax bracket, going from 32 to 30. The brackets above that, the actual brackets change, but not the tax rate. And the bracket below that, there was a change in the tax rate. What does that actually mean? If we go to the next one. So your income might be the same as it was, 6 months ago when you go to apply, but you've probably had an increase in your borrowing capacity because banks assess you on your net income. So, for example, that sweet spot that was the main beneficiary of about $140,000 of income, you've probably had an increase in your borrowing capacity now of about 6%, thanks to the stage 3 tax cuts. So just to conclude, some trends that we're seeing as well across the property market. So first home buyers have really been wiped out through these rate rises. They were strong and really prevalent in COVID. Lots of great initiatives in the marketplace for them as well. Lots of great government initiatives, that is. But now they've dropped off and basically the affordability is the big issue. We'll keep going. So regional areas, if you look at that ski jump or something you could call it, regional areas went crazy. I think Byron Bay in 2022 was the highest growing suburb in Australia at one point, and then straight after it came straight back down, as you can see all these on the average prices. What happened there is a lot of people got the working from home benefits. They moved out to regional areas, thought this is great, and then after a year or two, literally transactions that we made at Shaw Financial of people that bought houses in regional areas, after a year or two, they realised, I actually can't live out here and commute to the city 2-3 days a week. It's treacherous, and I actually want to go back to the office. Quite often. I don't want to stay at home 7 days a week, for example. So a lot of those people sold properties sometimes within a year or two of actually buying them. It was quite surprising. I'll keep going. So this is probably what correlates to why prices are strong. 1/3 of all owner-occupied purchases in the last year were buying with a 60% LVR or lower. So they're cashed up buyers that probably have a significant amount of equity in their current home that they sold to upsize, and they don't care too much about rate rises. They're making a decision on the fact that rates are going to come down in the future. If they can afford it for now, she'll be right. It's what they're thinking. We'll keep going. This one's an obvious one. Maybe you want to touch on this, Mark, but it's all over the news as well. Rental vacancies, record low. Low amount of stock. So to my point, there's not that many properties coming to the market as new investments, and a lot of landlords are selling their investments. So supply, once again, is record low.
Just on that, what we're seeing is we would normally carry as an agency in operation for 20 years. We could be at 40 properties for lease at one time, sort of about 35 to 45. We're back to those numbers. So what that graph is showing, I think you're going to now see vacancies start to go up a little bit, and I think that I think certain Northern Beaches, they're satisfying the demand for tenants that are out there. So yeah, it's pretty interesting because a lot of landlords are going, we got it now, we got them. We're like, hang on a sec, be a bit careful, be a little bit careful with your rent setting. Don't get too optimistic at the moment.
Yeah, they've already had their price increases in rent. They can't keep going. We'll keep going. All right, so to my point earlier, just comparing asset classes. So we want to highlight super as the example. Most people super is invested in the ASX, but to my point, if you're in a retail fund, you're probably underperforming this at the moment, 80% at least. But the ASX 200 for the last 10 years, total return inclusive of dividends or distributions was 7.94%. So on average, 80% of super funds are below that amount. We'll use that as the benchmark for the ASX. We'll keep going. What is, let's say, 250 grand as the example, because that could be your combined super with your partner or family or whatnot. $250,000 invested in the ASX 10 years ago, with the compounding annually, would have probably doubled. 497 there at the bottom. We'll keep going. So if we compare that to other asset classes, on face value, that looks like it's the best one, right? It's the highest, being 7.9%. But to Mark's point, you don't leverage your portfolio in shares typically. People did that back in the GFC and got burnt, and no one really does it again. And even if you do, you'd probably do it in a geared ETF or something at a very low leverage position. If we keep going and show what a leverage position in property looks like, so all those average growth rates, by the way, are the 10-year average. It's the same as the ASX average we gave an example of. And if we use 250 grand as the example of cash across all those asset purchase prices to be an 80% LVR, and we exclude the rental income because we assume that the rental income will cover the interest expense, you can generally achieve that just by going up or down in purchase price and going up and down with the LVR. You can see that the other asset classes have drastically outperformed over 10 years. So your $250,000 in super would have doubled, but if you put it into a city house, it's worth 1.8 million. Sure, there's a loan on that of, call it 600-700 grand with amortization. You're still, more than double your position in the share market, and all those other markets not far behind. We'll keep going. So to my point about, getting an investment property cash flow neutral or positive or negatively geared, it's entirely up to you guys what is best in your interest in terms of you have to seek independent advice and speak to your accountants and figure out what's suitable for your situation. Negative gearing is suitable to the individual that's a high income earner and wants a tax rebate.
Speak to my accountant as well.
Yeah, the accountant will cover all this. The positive gearing is for someone that wants additional income. The key difference there, I'm not going to go through line by line. Like I said, you've got this on your phones, but the key difference there is one's at 80% LVR, which is the negatively geared scenario, and the positively geared scenario is just at a lower LVR, being 70%. It's also a Brisbane unit, being a higher yielding asset. The house in Sydney, whilst it had more growth, was lower yielding. All those averages there at the bottom, by the way, the potential tax rebate, the depreciation, that's off the BMT website for averages as well. So assuming those income tax brackets of $120,000 to $180,000 a year, you could have a rebate of that $10,000 to $13,000 in that negatively geared scenario. Averages there also on the interest rate. We go to the next one just to break it down what that looks like. So over 10 years, the negatively geared scenario, you've amortized the debt down to 650, so you've paid down the debt down to 650. By that stage, the property's cash flow positive, and the accrued equity at the bottom there, 1.18 million. So a lot more than the super.
Lisa's going to kill you with all these numbers.
Yeah.
She's going to kill you with all these numbers. Lisa, what do you reckon about these numbers?
Well, look, I think I want to actually ask the crowd here if anyone's got any questions, because what can often happen is we hear these figures and it sort of goes in one ear and out the other. With all due respect, like, it can be hard to understand. I think the main thing that I would like to know, and maybe everyone out here as well, Theo, is do you personally foresee interest rates coming down sooner rather than later? We get asked this all the time from buyers. And then I was reading something today in the Financial Review. Slowing economy puts RBA rate cut on the cards. I mean, that's all we have to go off, right? What we hear in the media. What do you reckon?
Well, the thing is, for every article like that, there's another article that says the opposite, right? So you had the Judo Bank economist coming out and saying there was 3 more rate rises this year. I personally don't think we've got 3 rate rises. That's definitely not going to happen. But we're not ruling out one. And like I said, it's probably that August decision that's the most crucial, being off the back of the current quarter of inflation data that comes out next month. I I don't have a crystal ball to say what that inflation data is going to look like, but you can't rule out a rate rise. And if it's a rate cut, it's not till the end of the year, early next year.
Okay. And then I want to ask you this. If you were going to buy property, would you be doing it now or would you be holding off and waiting to do it?
So with all that data I was showing about borrowing capacities, I think the current climate makes it opportunistic because your competition that you're going to an open home and bidding against is crippled. Their borrowing capacity is 47% lower, as is yours, right? We all are feeling that pinch. So in my opinion, there's better value buying right now because people aren't throwing crazy amounts of money, borrowed money like they did maybe 2-3 years ago with 2% interest rates. The pressure has also been adjusted. If you're buying an investment property, for example, rent rises haven't equated to the same increases in interest expense. So the numbers need to make more sense at the moment. That's why yields have come up. That's why we have seen rental increases. It's not just because landlords are taking advantage of low vacancy rates. It's because the cost of owning a investment property has increased.
So has anyone got questions? Anyone? Yes? Okay, great.
Sorry, say that again.
The houses prices or apartment prices, only Northern Beaches goes up or in Sydney or Parramatta, for example.
Do all the house prices go up? Was that the question?
Yeah.
Well, it's
crazy jumping up.
Sydney compared to
No. So no. All the data I'm saying Sydney is across Sydney. Yep.
Parramatta is also.
Yeah. Yep. There were house prices I was referencing.
Because I hear in news all the time going up. Nothing going up in Parramatta, but here jumping up.
Well, I'll tell you something funny. Do you know in the GFC, which was, one of the biggest financial crises in the last sort of couple of decades, maybe 3 decades, does anyone know what happened to Sydney prices in the GFC? You would expect they came off like 10, 20, maybe 30%, right? 7% they came off when there was a lot more hardships than what we've been going through recently. Are we
heading for a GFC?
Well,
because a lot of people talk about it.
By definition, we might already be there, but our economy is actually proving to be very resilient. Our share market is hitting all-time highs every week or two at the moment. The reason the share market is hitting all-time highs is because all those businesses are doing really well. Yes, households are feeling the pinch, but people are still buying property. There's still a resilient economy is the general consensus.
I know Brendan's got a question.
House price growth versus unit price growth. 7% versus 4% the last 10 years.
Okay, that's my favourite question for the night. It's my favourite question for the night. I'm really passionate about this one. I look at the data across Sydney, across all of the suburbs. Lisa loves data. Okay, houses, Northern Beaches have done 130% capital growth. So for people who aren't that good at their maths, if you've done 100% capital growth in 10 years, you've doubled. You've done 50% of cash capital growth in 10 years, half of the value of the asset went up. It doubled, half the value doubled. So if it was a $1 million property, did 50% capital growth, you're at 1.5. Houses have done 130% in the last 10 years, rolling average. In 32 years of my careers, I've always watched the rolling average. Units have done 70%. Units have underperformed massively. Why? At 2% interest rate, I'm going for a house. I don't care about everyone else. It's 2%. I'm going for a house. So there was terrific growth with houses. Now, the way we differentiate units and houses is we call it strata, that category, and Torrens title, which is, it can be a whole warehouse or it can be a house in Narraweena. Torrens title and then strata is like a unit, a warehouse and things like that. They performed at 70%. So if you had a unit worth $1 million, that would have gone to 1.7. That's a 50% difference between how houses have performed and how units have performed. Why? Because money was 2%. Real simple. Now when it's 6.5%, I'm running to the unit because it's more affordable, because it's 6.5%, because my repayments are triple, I think. So I reckon the category to watch, and traditionally, houses and units have always doubled every 10 years. They've twinned the whole way along. Families came to me and said, should little Johnny buy a house? Should little Johnny buy a unit? They perform the same. It's only the last couple of years you've seen that gap open.
Does that mean, Mark, that you expect that gap's going to close again? So,
Any other questions, guys? Questions? Why you got these guys here? Who have we got? Question.
Yeah, Mark. So you were saying, yeah, so what are the other key reasons that you think that units will perform? Do you think it's related to supply as well, due to less units being produced at the moment? No? Just affordability.
Yeah, look, I think purely off affordability, it's everyone's rattling on about building and everyone's rattling on about population. It's all valid. But I think that the fundamental is it's just off the back of that sentiment, the way people feel. And, you know, at the moment, you know, when your interest rates are triple, you know, you don't go out and put a pool on, put a second story extension on, or, you know, you may, because you just sold the investment property, you're going to double down on your house. But on average, people are more conservative in a higher interest rate environment. And I think that's when they'll spend less. And then that, you know, the median price for a house to a unit is vastly different. So, yeah, I don't think it's on the back of supply.
All right, thank you.
Quick question. If you're starting out from the beginning, like you've got a bit of savings behind you, you live in the Northern Beaches, and you want to build, let's say, a $10 million portfolio, what would you do first? Would you buy your own home first, pay that mortgage down, and then invest? Or would you invest first, like on the beaches or outside of Sydney?
I think, well, firstly, on that last question, diversity is the key. So you should look at always sort of spreading your assets in different markets and even different classes, to Mark's point about houses and apartments, because they run in different cycles. I don't think paying off your home before you buy investment properties is feasible, just because it'll take you probably so long to do so these days. I think if you're at the start of your wealth creation journey, let's say in property, you've got to be comfortable with debt. There was even an article in the AFR last week talking about how people are comfortable carrying debt into retirement. If you've got enough income off your investments to service the debt, so be it. So I wouldn't worry too much about paying off your home and being in a comfortable debt position. Comfortable debt position, in my eyes, is just making sure you've got enough income, including passive income from things like rent, to service your debt.
Yeah, 100%. Because I've got... it doesn't make sense to me to like pay down the mortgage and then start building a portfolio. And I've got someone behind me saying, oh, you should buy your own house, pay that all the way down, and then buy another one and pay that down. And then I was like, that could be like a 50-year plan.
There's little things you could do along the way to make sure you're doing it in the most tax advantageous way, which is something Emmanuel could help with. So people make sort of silly moves here and there, and you can't change it after the fact. When you transact on investment property, that transaction is stamped at that point in time. So, for example, pulling a deposit for an investment property out of your home loan, big no-no. Your home loan being your own occupied loan, because that's not deductible. You always should try and gear your investments, do a cash out if you can, or cross-collateralise. You should always focus on additional savings being against your home loan, and then just make sure you gear things accordingly.
Any other questions, guys? Anyone? Yep, perfect. We're going to pass. Oh, sorry, Theo.
Just the one thing I wanted to cover on, because we touched on it a couple of times. The one reason why we're using SMSF as an example a lot. Do you want to go through a couple more?
Yes.
We won't do the price forecast. Everyone's probably seen that by the banks. You can download a copy. Keep going. We do have a report that we release. Keep going. It's the State of Sydney report. If you want to, I guess it's on your phones, but you can download that, which forecasts markets of growth based on assessing real estate portal data. So it calls out areas of growth based on different quintiles, which is average prices, using real estate portal data. So activity, days on market, asking price versus sold price when it goes on market. And the accuracy of this report got us on Channel 9 News and 2GB. They love this report. I won't go through every suburb. We'll quickly go through just to the end. That's all the suburbs that's in there. Keep going. We've compared forecasts with actuals. Keep going. Yep, sorry. One thing, keep going. So the SMSF, the reason why we've been talking so much about superannuation and comparing it to purchasing and property is because the doors have opened to being able to borrow in your super. A lot of people still think you can't borrow in super to buy a property. That's a bit of a fallacy. It's actually gotten easier. The reason you think that is because the major banks got out of it, and so they're telling everybody it's not possible anymore. But there is countless lenders out there that specialise in self-managed super fund lending. The real great call-outs for it, you don't need to service outside of your super. The servicing is based on just the super contributions and rent. If you haven't been making enough contributions, you can just get an accountant's letter if you're self-employed to say you'll make more contributions in the future. So it's almost like a low doc loan. It's very easy.
I think that's a massive one there, guys. I've got to emphasise this. What you do in your super is completely isolated and separate from what you do yourself. It's weird. It's really strange. So I can borrow $1 million in my super and then I can go and get a home loan for $1 million. The people that I'm getting the home loan from do not care that I've borrowed money out of my super. It is completely different. So I think that's really powerful what you said.
So just to highlight that point, that means some people can't actually afford to buy an investment property in their personal name. They've gone to the bank and they've been told no, but you can buy one in your superannuation.
That sounds almost strange, but it's a fact.
All right, and that's a perfect segue, I think, to Emmanuel.
Thank you so much, Theo. You're going to hang around so we can get some more questions? Awesome. Thank you so much. We'll pass over to Emmanuel now from CCS Partners.
All right, guys. Thanks for giving me the opportunity to help you with the technical side of it. I think I might ask, even though you've just been asking questions, is there anything special that you want to know before I start? Because I'm going to go through and give you a big picture of how it all works, an idea. But has anybody got a burning question before I start? Because that way I know I can answer that specifically.
An accounting question. And Emmanuel explains
question.
Things that even I can understand, and I'm not great with figures.
Yeah.
Guys, so Stefan Bubalow's my name. I work in real estate. You'd think I'd know all this stuff as well, but we don't really follow this as closely as well. So this is great. The question I've got to know, and I'm sure you'll cover it, is what are the stages required? I've got my money sitting in a managed fund right now. I want to pull it out. What do I need to do to set up a self-managed super fund? We hear about bare trusts. We hear about setting up corporations. Just the stages, I guess, that would be involved for a mum and dad or somebody young who's got enough money now behind them to get it into a property. But what do we need to do to move it out of a managed fund and into our own self-managed super?
Okay. It's a very good question. It is a can of worms, but we're going to come to a diagram, but I think I'll give you a taste for it to start with. At the moment, if you're an employee, your employer has to contribute 11.5% of your package to super. You earn 100 grand, just making the numbers easier for me. You earn 100 grand, your employer has to put 11,500 into your super fund. End of story. So your super fund is growing every year by at least 11.5%, and it's going to go to 12%. All right, so it's cash money. It's not borrowed money, but it's your money. All right, so what can happen? What happens there is that you are given choice. You can either put it into a public fund, and here you've got just a plug up for your names. You've got First State, you've got Australian Super, you've got a whole lot of them that will take your money that has to be contributed, and then you can choose. Do you want it in low risk, and therefore they basically put it into cash investments? Do you want high risk, which means they put it into overseas shares, for instance? And so what's happening is that your fund is growing every paid packet you get. What can you do with it? You can leave it to the managers. Now, those people are paid millions of dollars worth of bonuses to look after your money. That's fine. But you have the option. You can actually set up your own self-managed super fund. Now, there are regulations in regards to setting up a self-managed super fund, which I can go through. But in simplicity, what happens is you set up your own fund. You need a trust deed, a super fund trust deed, which is regulated by the government. They have given the rules as to how you do it. You need a trustee company, if not individuals. And therefore, what happens is that you don't give it to, say, Australian Super or to any of the others. You give it to your own super fund. You instruct your employer, or if you're self-employed, you make your contributions to your own fund. So it's totally separate from you. You cannot take money out of it and pay off your home loan. You cannot go and buy a car out of it. It is there to be invested, and there is a definition of what investments it can go in so that it is available to you when you reach retirement age, because the government doesn't want to pay you an age pension. They're simply saying that we are forcing your employer, or you can choose to make super, so that when you get to retirement age, which is now 67, you'll have enough money that you can live off. All right, so the attitude is that, right, this money that's going into your fund, I want it to grow. How do you do that? So you can control the whole thing, but there are rules that you need to follow to do it. All you're doing is replicating what the big funds are doing. The only trouble you have, or not trouble, it just depends on what your interests are, is that you need to manage it. You need to determine the investments, whereas in a public fund, you are paying somebody that's meant to be an expert to manage it for you. So it's all about how good are you versus them. Now, in some cases, people say the funds, they charge too much in fees. I reckon I can do it myself. I know how to look after a rental property, so it's possible. All right, so what I'm getting at is that you can create your own fund. It can only have 6 members in it. You can't invite the whole of Australia to join your fund, and you need to look after it and do tax returns, do financial accounts and the likes.
Those people can be different ages.
Yeah. All right. So all it is that anybody that must have super contribution paid to them, and you need to be over 18. Your employer, all the kids that are working for McDonald's, for instance, that are under 18, McDonald's does not have to contribute super for them. Right, because they're too young to look after it anyway. They don't have a legal right how they can control their super. But once you get to age 18, you manage your own.
So on Stephen's example, Stephen comes along and he's got Steve's 55, 60 years of age, and he's had super going in for 30 years. 10%-ish of his wage. He's had about 10 grand going in 30 years. There's 300,000 there. His wife's got 200,000. Yep. They can go out and put a self-managed super together. You're doing those for free tonight for everyone here, I believe.
Oh yeah, I've got all night to do them.
What is it?
Yeah.
What does it cost Steve to put together self-managed super, and how much input from him? Does he have to go get a degree to do that, or does he pass the sword to you and say, can you handle it? What does it cost?
Okay. It gets down to how interested you are. I've got to say this, all right? So there are people that don't really want to do this. It's just like who doesn't want to mow their own lawn? Okay, you get somebody else to do it, even though you can do it. So you have to have an interest because you have a responsibility. You need to know some of the base legislation. There is people that I've had that have said to me, I want a self-managed super fund, and I'm sorry, they can't control their credit card, let alone control a super fund. So there is a responsibility involved, and you need to be able to do that. Now, as to the cost of it, to set up a super fund, you must have a trust deed. You must have we generally recommend a trustee company to set up. It's different if you're going to buy a property in it, but there's no change out of $1,500 to set one up. But it's up front. After that, you do need to lodge returns and have an audit of it done. So each year we find that they can cost $2,000 to $2,500 in accounting, in audit fees, in lodging returns and the likes. So you've got to make sure that it's a worthwhile exercise as well. But the beauty of it, the thing that's encouraging is that you are having super put somewhere for you. You can determine how it's best used. Okay? So yes, you can do it. Yes, if you've got a base amount, like as Mark said, if somebody's got 300, the spouse has got 200, you've got $500,000 that's sitting there. Should you, if you like real estate, which obviously a lot of us can handle, then you can use it to buy real estate. The question is, do you buy a $500,000 property, or do you buy a $1 million property and arrange a $500,000 loan against that? Now, the beauty is, as your employer puts super in, that money's going towards the repayment.
Yeah, that's massive.
So you're not finding the money. I mean, you've got to stay employed, but you're not finding the money because it's going somewhere anyway. It's just you have choice.
Can I continue the narrative of Stephen buying through super? So Stephen, 55. He's got, I actually don't know how much money he's got in super, but I'm just guessing. He's got 200,000 in super. He's thinking, you know, I can't do much with this. So if he wants to leverage that, he can borrow money. His super can borrow money from a bank, and it may be able to borrow another 400,000, 500,000, or his super can just go and buy something in cash.
Correct.
So I'll give you an example very quickly. We're going to tap through this. Storage unit, 198,000, next to the biggest Bunnings in Australia, in French's Forest. That's what it looks like. 2 stories, so you can stack a car 2 high, believe it or not. Always going to be in use across from Bunnings. Stock list of what's in there, price list of what's in there. Steve can buy one of these, put a deposit down of $19,800 with his self-managed super.
Correct.
And then in 2 or 3 year times, when it's finished, when it's ready, he can actually buy it in cash through his super.
Correct.
That's not leveraged. He's just buying it in cash.
Correct.
But then he can come to you and you can go through someone like Granite Home Loans and you can say, don't spend $200,000 on that, buy a warehouse. And then you can go, oh, we're going to get $500,000 for you, go buy something for $700,000 or go buy a unit.
No, Mark, you're going to tell them to buy 2.
And there you go.
There you go.
Well done, Steve. You just, congratulations, you bought a property tonight. Well done.
Yeah. Yeah. All right, so it's all doable. It does have an upfront cost. It does have an annual maintenance cost to it because you have to comply to certain regulations. The government is saying your super fund, when it earns income, it's only paying 15% tax. There's nobody in this room that pays 15% tax if you earn over 20,000. Okay? And then once you retire and you start a pension from your super fund, you can pay 0 tax. Okay? So the government simply says, in order for you to have those benefits, you've got to be a good boy or girl on the way through. But it's not difficult. There's plenty of guidance there to help. Anyway, it's good that we've got to that aspect of it, but we'll get specifically because there's some diagrams which are quite good. So what I'd really like to start with is simply saying that if you want to invest, there's a whole lot of structures that we understand in Australia. And this excludes the self-managed super fund is actually underneath the arrows. But let me just give you an idea just as a rounder. You can simply go out and buy a property on your own. As I was saying beforehand, you go and buy $1 million property, you've got a $200,000 deposit. For instance, you go and borrow $800,000. Now, the rent return might be 3%, yet the interest rate is 6%. Therefore, what's happening is that you are paying more interest than you are receiving rent. That is a personal tax deduction to you. So if you've got a $25,000 loss from the property and your income is 100 grand, then your income drops to 75,000, and therefore the government is subsidising you 32% of the interest. Now, if you've got a pocket full of money, if you won lotto, then you buy it individually, you're already earning enough money on what you've got. You buy a property, you've got a positive rent, so you might earn 52 grand, $1,000 a week. The expenses are going to be maybe 20 grand a week, 20 grand a year. You're going to have 30 grand's worth of rental income out of it. They're going to add it on top of your existing income, and you're just going to pay more tax depending on what rate you're at. And it could be at 30%, it could be at 45%. That's not a problem because there's still money left over. I don't mind earning more. I don't mind paying more tax because tax does not take it all. It takes enough, but at least there's a leftover. All right, so an individual can buy, you can be positive geared, you can be negative geared. If you're negative geared, then you'll receive tax concession, tax refunds that help you pay for your property. Alternatively, you can buy a property in partnership. I can buy a property with any one of you and we can be 50-50. So what happens then is half the rent is mine, half the expenses are mine. The other half are yours. You include half of the net result in your personal returns. If by chance we've borrowed and we end up again with losses, we put half the loss in each of our returns and therefore we get a tax saving on it. The next one is, yes. You can. There is one catch. You cannot put a mortgage on that property.
It's very hard to borrow money. It's possible, but it's
possible.
But it's
Okay. The question was, can you buy a property with your super fund? Okay. Yeah, a partnership. Okay. So we have your super fund and you have me. And we simply say we want to buy a property, but we don't want a full exposure. So your super fund buys half share and I buy half share. Okay? Now, the difficulty there is that if we want to use that property as security, you've got to jump through a few hoops.
If I have enough money as in my individual and enough money in my self-managed super to buy one property,
yep,
is that possible, or do you have to be arm's length? Or
it could be. You could
just no bank will really easily lend to your super in partnership with you as an individual or a random individual or a company.
Okay.
It's near impossible to get the loan.
And if you lose money, say 1 year, if you had to do renovations, are you punished or penalised for the super fund?
All right, let's do repairs, not renovations.
Yeah.
Renovations are a different issue. You're not, because the super fund's got to bear the same proportion of the costs.
Okay.
Okay, you know, we've had a big storm. The insurance company pays for fixing the roof, but we've got a $2,000 excess. Okay?
Yeah.
So the property is half owned by the super fund, half owned by you. Then the $2,000 excess that's paid, you get to claim the half, the 1,000, and the super fund claims the other half.
Okay.
But if you work on the basis that the super fund is a cash buyer,
Yeah.
then unless it's vacant, then it will always have positive cash flow.
Okay.
Okay? So the answer is yes, you can.
Guys, has anyone else got any questions for Emmanuel? And just to reiterate, these guys don't usually come out and do these sorts of talks, so to have them here is just invaluable. Anyone, accounting, something for Theo? Rob. It's nice to hear from you, Rob.
How much can we contribute to super annually?
Okay, for the current year, you're allowed to contribute $27,500, your employer, and you can top up to $27,500. Next year it's going to $30,000. Okay, per person. That is the amount which somebody can claim a tax deduction for, either your employer or yourself. On top of that, you are able, if you've got spare cash in the bank, at the moment, to put $110,000 per year. It will go to $130,000. So you've got a lazy $110,000 at the moment, and you say, well, it's sitting in the bank, I'm earning 4.5%, I earn $100,000 a year, I'm paying tax on that. How about I throw it in my super fund, and my super fund only pays 15% on that, whereas in your case, you could be paying 32% on it. So yes, you can put it in. Okay. There are some other circumstances.
What was that total per year?
110.
Okay.
Right.
And just say I didn't contribute last year. Can I contribute retrospectively?
Yes. What's happening is at the moment, the tax office is allowing people to do a catch-up. So what they're saying is that in the last 2 years, it's been 27.5. Let's say only 11,000 has been put in for you because your income's been 100,000. All right. So you have what's called an unused cap of the difference between the 11 and 27.5, and you can go back over a 5-year period. So just the other day, I had somebody that had a low income, and he says, "I've got a whole lot of money now," and we worked out how much they could put in, and it was 85,000. So that for 3 years ago, where the figure was 25, they only put 10 in. So there's 15 for 1 year, 15 the next year. Then basically it increased in levels, and you can make a once only, say 80,000, on the condition that your fund balance is below 500 when you do it. If you've got 10 million in your super fund, no, you can't make up unused, what they call unused contribution cap. Sorry? Which is a non-concessional, correct.
Can I ask the question, if you were to buy an investment property inside your super and it was negatively geared, do you have to top it up with your own money, or can you use that monthly contribution from your employer to bridge that gap?
Okay, perfect question. Number one, the contribution your employer puts in will assist in repaying the loan and the interest. Then you've got to do the numbers, and if there's a shortfall, you need to put it in, and that's why I said you can do the 110 per year, which is going to go to 120 a year to supplement it. So yeah, but you need to look at the model to see whether the super from your employer and the amount that you can afford to put in yourself will cover you over the time period where you may have a shortfall.
Can I just jump in there? The bank at the point where you purchase the property will make you do that model up front as well. So you've got to.
So you'll know before you get into it.
Before you commit to it
how much you've got to put in out of your own pocket
forward.
Yeah.
And the bank also puts buffers on the rent. So they'll say if the rent's not covering it, there's a shortfall or negatively geared loss of X.
Yeah.
You've got to make sure you're prepared to contribute
Cough up
X
out of your own
over
pocket
each year for the next, indefinitely, basically.
Yep.
Okay, so up on the screen you can see what I've already answered because you've asked the questions, which is good. All right. So you can see that at the moment, 27.5. Your employer puts in, if you're not earning basically 250 grand a year, you haven't used up your 27.5 contribution cap. Like I said, I use the example if you earn 100 grand and there's 11 grand's gone in, so you can then supplement it with an extra 1650 yourself. Yeah. Okay.
Right, we've got another
Let's go
question
to the
here
next,
when you're ready,
and
man.
then there's the extra contribution. Okay. So, all right. Then the next one, you said if there's a shortfall, and I said to you, you can put 110,000 in. There's your 110 sitting up there, or you can bring forward the next 2 years and put 330 in. So sometimes people have got cash sitting around and they want to put an amount in their super because they're not able to. One, they may not want to borrow and have a high level of borrowing. They want to bring down the borrowing amount and therefore they'll contribute more. You are entitled to put in additional.
Yep. Just a quick question. So in relation to there being a shortfall if you had a negatively geared property, but do you have to get financial advice every property that you buy in a SMSF or only when you set it up?
Well,
you actually... Okay, if you set up your own self-managed super fund, you are signing off that you understand what the fund is all about. The only one that forces you to go and get financial advice is potentially a lender. And it traditionally used to be the banks. And that's why the banks, can I say it, have gone out of it a bit because they found it too difficult. So... the bank would turn around and say, I want your accountant to sign off that the level of borrowing, that you have the ability that you can service it pretty easily. Unfortunately, that used to put the pressure on us to effectively tone it right down to consider if there was a disaster, right? Because the problem is you buy a commercial property and the problem is it could be vacant for a year. How the hell are you going to fund it? As soon as you buy a residential property, drop the rent by 50 bucks a week and you should have people falling all over you. Okay? All right, the other thing that you need to understand is the downsizer. Now, yeah, I've got people in here that would be downsizing. And what that means is that if you choose one, if you're retiring, you say, kids are gone, house is too big, don't want to maintain it, I want to travel, I'm going to go and buy a unit. So you sell your average house price these days, 1.5, 1.7. And no, it doesn't have to be a house, but I'm just using it because you sell a $1.7 million house and you go and buy a $1.2 million unit. So you've got money left over. You're going to invest it, all right? So what happens is that above the age of 55, you're allowed to contribute up to $300,000 from the sale of your property into super. So as I said, $1.7 million property, go and buy a $1.2 million unit. You got 500,000 left over, his and hers. You can turn around and simply say, well, we just want to throw the 300,000 or the 250 each into super and let it work for us. Because now, once you put it into super, do you have it in a public fund? Do you have it in a self-managed super fund? All right. In the past, what people used to do, go along to the bank, put it on term deposit, you know, on current standards, earn 4.5%, pay tax. Put it in a super fund, and max tax you're going to pay is 15% on the earnings. And if you're in pension mode, pay nothing if you're under the 1.9 million cap. Okay?
I just want to call out with one thing about, we're talking about super obviously a lot, and we're talking about some big numbers. You don't need, for example, $300,000 to $400,000 or $500,000 in super to buy a property. These days, our most common transactions are probably around $150,000, $200,000 in super, which is typically a combined balance of a husband and wife or de facto couple, or like Emmanuel was saying, you can have up to 5 or 6 members, which could be siblings and family members and whatnot. So 150 to 200, I'd say, is the sweet spot. That's probably our most common transaction. The other thing, just to go back to something that Mark said earlier, I just want to cover off the flip side about the borrowing capacities. The reason why it's also becoming a growing focus for investors deploying their super into is because typically a lot of people want to buy a property in their personal name as an investment property or outside of super. However, they can't commit to it because they're thinking about upsizing their home, and the borrowing capacity always gets crippled in the investment property. So they keep kicking the can down the road and never buying an investment property. The good thing about the transaction in your super, it will never hinder your ability to buy a new home or upsize the home.
Yeah. I think what
I just have, just to sort of start to wrap it up, because I'm aware we're just starting to get on time. Got one more question here. I want to know individually what each one of you would buy in any capacity. What would you buy as an investment?
something that doesn't take a lot of maintenance and somebody else will look after it for me. All right, so therefore a unit is more appealing, but that's a personal preference. Okay? Can I tell you? Should buy a Bunnings unit. That's it.
Yeah,
all right.
Have we got a property for you?
Exactly. Now, that's even better because what can happen is you can store your own stuff. So that I need to make one more thing clear, which is I think is very important. If you buy a residential property in a super fund, you cannot occupy it, nor can any relative of yours. So residential and related parties are out of the equation.
What about if it's a holiday rental and you rent it off yourself when you use it?
Still a benefit. The tax office says, because there's a fine definition whether you are a business and running an Airbnb with an ABN.
So if there's an Airbnb
and an ABN, it's a business. All right. Whereas, and I'm not pushing the storage unit. Mark will do that for you. But it's a commercial property. So what can happen is you can buy a commercial property, you can store your own stuff, but you have to pay your super fund rent. The most regular commercial situations we have, when you walk into a doctor's or dentist surgery, highly likely the surgery is owned by their super fund. Walk into a mechanic's premises or a lot of commercial premises, it's all owned by their super fund. Okay? They're paying themselves rent.
Yeah, Theo, what would you buy?
I like Mark's call out about houses versus units because I feel like you go to where things haven't performed to buy. And I think units actually look attractive because they haven't. Houses have had a ridiculous run. Go where the results haven't been in the last few years.
Yep, I agree. I want to ask Mark.
Everyone's got to go, but you can ask questions afterwards. Stay, hang back.
We've also got one more question here.
One thing I haven't mentioned and meant to attribute to what you just said. We have a house in NARRAWEENA. We are over as an investment. We are over the land tax threshold. We have to pay $580 per week in land tax to supply that property to a tenant, an average property. If you're in Beacon Hill, NARRAWEENA, Allambie, and you're over the tax threshold, because I'm a house, I have to pay $580 in land tax before I paid interest, before I paid maintenance to the property. With strata, it's a quarter. So you can have about one house and you're over the threshold. You can have about 4 units worth $6 million total and you're still under the threshold. So land tax is another good one for it.
So the question of the night is, what is Mark Novak buying? Now, I just want to say before Mark actually answers this, yesterday every Monday or Tuesday, it was yesterday because it was a long weekend, we go and we do this thing called sales caravans. All the sales people get into the Novak van and we go and we see all the new listings. We had a whole lot of them yesterday because it was a busy listing week. And Mark goes, oh, we're just going to go up and we're just going to have a look at these storage units. And I was like, oh, Mark, I've got to get back to the office. I'm not going up to look at storage units. No girl wants to buy storage. Anyway, up we go. We go and have a look at these storage units up in Warriewood. But we've got some in French's Forest. We call them Bunnings storage units. And I have to say, Mark opens up this roller door and I'm like, what's this? He's like, this is a storage unit. I was like, what? This is unbelievable. It's got these bright yellow doors. Everything's all automated, massive, big, high ceilings. Some of them had mezzanine levels. And I was like, hang on a second. I never knew these were storage units. And I'm not even, like, this is not a sales pitch. I'm genuinely telling you.
And I said, it's not a storage unit, it's a warehouse. And you went, oh.
And I was like, hang on, how much are these? And Mark's like, they're $195,000. I was like, wait, what? How much are they renting for? Anyway, and then on went the story and I was like, we got to buy some of these. Mark said, we have bought some. But this is a great investment, little did I know, in our super. But I have to say, what I did love about them, and I sell residential secondhand stock usually, what I love about it was hardly any strata. Like if you think about storage, there's no maintenance on it. There's absolutely no maintenance. And then strata was like $400 a year. So it just, when these guys are talking about buying investments in your super fund, listen to what Emmanuel said. I would buy something that's low maintenance and that's going to rent well. This is it. Over to you. Very quickly.
We're done, I think. I think everyone loves low maintenance. So it's a good low maintenance investment. But don't forget that phone number. If you SMS Warren, you're going to get my favourite, the compounding calculator, and the Warren Buffett movie that I want you to watch. Great movie. If you SMS that number with the word SMART, you're going to get all the notes from tonight, all the slides. And if you SMS Bunnings, we're going to send you the storage units and the warehouses in an SMS. So hopefully that's handy. Pass it on to friends and family. Any questions, we're here for you tonight. Thank you for your patience. We went on a bit longer than we wanted to, but that's what happens when you get a real estate agent on a microphone. No apologies.
And
Thanks,
thank you
guys.
so much. If we can just put our hands together, guys, for Emmanuel from CCS Partners, Theo from Shaw Financial, and Mark. And also to all of our staff, because this was a big setup today. So thank you to everyone who chipped in. We're going to be here if you guys want to ask any questions or buy storage units.